This episode is brought to you in association with Janus Henderson Investors.
It is a marketing communication,
Is not for forward distribution, and the value of an investment can fall as well as rise.
past performance does not predict future returns.
And nothing in this episode should be construed as advice. Our discussion is for illustrative purposes only, and references made to individual securities should not constitute or form part of any offer or solicitation to issue, sell, subscribe, or purchase the security.
Not for distribution in European Union member countries.
Hello, and welcome to Trust Radio, the investment trust podcast hosted by Janus Henderson Investors, where we take a deep dive into the questions investors really want to know the answers to. My name is Andrew Chiguri, and today I'm joined by Sat Duhra to talk about activity within the Asia-Pacific region, such as the performance between North and Southern countries, what's going on in China, and the dividend trends in the region. Sat, welcome to the show.
Hi, Andy. Thank you.
There seems to be a tug of war in the markets right now. One side says reasonable growth will continue to push up inflation and keep the Fed raising interest rates. Meanwhile, the other side says slowing growth will ease inflation and allow the Fed to stop hiking. What are your thoughts on that?
Yeah, I mean, this is really the key topic in markets today. It's something we are looking at a lot. It's something that's discussed a lot. And it's not really red hot growth that's created this inflation. There's been clearly a unique scenario where it's COVID-induced supply shortages, and of course, this COVID zero policy in China has just made things worse. And the Ukraine war has created essentially an energy crisis, and that's really stoking up inflation. And along with the recovery in demand from COVID, all of these things came together to create these incredible inflation numbers we're seeing today. I mean, numbers we haven't seen for 30, 40 years in some Western economies. I have to say, in Asia, it's not at such a level. I mean, certainly in North Asia, inflation headline numbers are much lower. But we don't think this is easing anytime soon. It's likely that we begin to see some headline numbers peaking maybe in the next few months as the oil prices come off. But the absolute inflation numbers are still very high. And so that inflation rate still is going to have a big impact on the cost of living. It's going to therefore have an impact on consumer behavior and ultimately corporate profitability and GDP numbers. So I think that some caution is warranted because of that. The earnings outlook is weakening, and we're seeing that in Asia. I mean, Asia probably has been a little bit quicker in that regard, and maybe in Europe and US we might see a little bit of appear to have seen a lag there. But I think Asian earnings have corrected a lot, and I still think there's some to come. The two areas that really stand out in terms of earnings expectations being too high would be consumer generally, so consumer discretionary predominantly, and technology. We're still seeing some weak numbers coming out of those sectors, and consumer behavior is changing. We're seeing some evidence of trading down. Inflation is biting, and therefore there is going to be an impact. So to answer your question, I think it's something that we have to be very wary of. It's impacting the markets that we invest in, and it is impacting corporate earnings today. So, I think moving a little bit more defensive, which is what we've done recently at the margin, has been the right thing to do.
We'll come back to that inflation topic in a second, but another risk that's coming to markets at the moment has been US-China tension surrounding Taiwan. Now, they've resurfaced again, causing volatility within the region. Should investors be concerned at this stage, and how real is that threat of escalating at this point?
Yes, this situation with Taiwan has certainly created a lot of noise in our region. But I would say that, of course, this US-China tension with respect to Taiwan has created weakness in the Taiwanese market. I mean, that's something that has certainly happened. And Taiwan has been one of the weakest markets in Asia this year. It's also one of the weakest currencies. And the foreign equity ownership in Taiwan is the lowest in about 5 years. So that tension has contributed, but I would say the key factor, more important than that tension, has actually been the weakness in technology names. Now, this is quite unique to Taiwan because Taiwan is really dominated by, or the Taiwanese indices, the Taiwan index is really dominated by technology names. And of course, we all know about TSMC, but below that, there are a whole host of names that contribute to that index. And therefore, the weakness in technology has really been the key determinant in the weakness of that market. So what we've seen is weaker demand for consumer electronics. There's been evidence of weaker demand for smartphones, for notebooks, PCs, and that's being spread to other areas now, areas that were previously more resilient. For example, AI, cloud services, those kind of things. And I think we're going to see weakness across the board there. The inventory overhang is very real. We've had companies reporting in Taiwan that the level of inventory has been too high, and some of it may be obsolete or they'll have to be marked down. It's going to have an impact on the P&L, and margins are being squeezed as well. So I would say that's been the key reason for the weakness in Taiwan. But of course, the tension with the US hasn't helped. And it's actually been negative for the Chinese market as well. So it is there in the background, but it's not the key reason.
Looking at the trust more specifically, you recently mentioned that you're focusing on upstream companies versus downstream. Could you talk us through what that means and could you highlight some stock specific examples within the portfolio?
Yes, I mean, let's rephrase that. We can put it another way, and we can say that we focus on the enablers of some of these key global themes that we're seeing today. So that would be things such as electric vehicles, AI, artificial intelligence, robotics, cloud services, renewables. I mean, all of these kind of buzzwords we hear today, but they are things that are going to grow. I mean, electric vehicles, renewables are very much real themes that are growing at a fast pace. Now, for our kind of strategy, given that we are value and income, we have a value bias and we focus on income, it is difficult to invest in the kind of headline names in those sectors. So we don't buy, for example, electric vehicle manufacturers because they are hugely expensive and they don't pay much yield. What we do is to invest in the enablers of that. And that's really the point of this, is that by owning, for example, the chip companies, the material companies, and the materials that are required to build renewables, build electric vehicles, and so on. And these, and companies, for example, that help to finance renewables infrastructure. I mean, that's one of our big holdings. This is the way that we get exposure to these kind of themes. So there's much better value there. There's higher yield and the prospect of dividend growth. And actually, it avoids taking a single bet, a bet on a single theme. And it's for example, chip manufacturers are providing kind of raw materials for all of these sectors. So it's an important area. And that's what we mean when we talk about upstream and downstream, is that there's a different way of investing. So we would buy, for example, copper play instead of buying electric vehicles, because the amount of copper that's needed in electric vehicles is much higher than internal combustion engines. Also, lithium is an interesting area, where we see upside. So that's what we mean by that.
Interesting. You talk about value within the market, and one of the areas you've highlighted as having good value is Korean telcos. Could you talk us through, that investment case for some of the telco stocks that you hold within the portfolio?
Yeah, so we think this is an interesting area. I mean, it's a very good example of value in our market. So we own two Korean telcos. What they have in common is that they have very high yield, so around about 6% yield. They have low valuations. So if you look on traditional metrics such as price to book, price to earnings, they are certainly cheap. But they also have double-digit earnings growth. What telcos have done recently, and not just in Korea, but generally across Asia, and actually they've been a strong performer this year, is that it's not just that they are defensive. There's actually a 5G story that's really taking life in our region, and the infrastructure has now, to a large degree, been done. I mean, still underway, but a large chunk of that has been done, and we're starting to see the upside in terms of margins from customers moving from, for example, 4G to 5G. I mean, some markets are moving from 3G to 4G, but that transition is creating upside in margins. And the other thing is that in this kind of period of recovery from COVID, we are seeing roaming revenue coming back as well. So telcos were meant to be a very defensive play during COVID, but in fact they weren't, because a whole bunch of revenue which came from roaming revenue disappeared because people weren't traveling. Now that's coming back quite quickly. And that's creating some upside in terms of earnings. So there's actually a genuinely interesting story in that sector for once, I must say, because it's always been more of a defensive high yield play in our region. But I think the thing that's different about our region, when you talk about some of these high dividend yield areas, whether it be telcos or infrastructure utilities, is that there's inherently more growth in our region because the infrastructure is still being built out. and there's a lot of growth yet to come. So, for example, fixed line, broadband service, pay TV, that's still growing at quite a fast pace. Whereas in more developed economies, it's already there. So that's the opportunity in that kind of area. And Korea at this point is one of the most interesting.
Looking at the region and some of the dynamics that are playing out there, we look at last year, North Asian countries performed well, and they largely performed well, driven by tech stocks. Meanwhile, Southeast Asian countries struggled. However, this year, that's been the reverse, with Southeast Asian countries outperforming their northern counterparts. What has been the driving factor behind that rotation?
Yeah, it's a good observation. I have to say it has surprised us because normally when you see, for example, a stronger dollar and you start seeing stress in markets, I mean, South Asia tends not to do so well, whereas North Asia tends to be a bit more defensive because they have, certainly over the last few years, they've had stronger earnings, they've had good quality companies, and actually stronger macro as well. But this time round, it's been very different. We've had a strong US dollar. I mean, in fact we've had a very strong US dollar, and actually, if you look at the strongest currencies relatively within in our region this year, it's been the Singapore dollar, it's been the Indonesia rupiah, it's been the Indian rupee, and the weakest currencies have actually been the Korean won, the Taiwanese dollar, and the Chinese currency. So it's turned on its head, and in fact, the likes of Indonesia are actually thriving in this environment as a net exporter of commodities. And so, that, for example, is a market where we've added some exposure. But South Asia is in better macroeconomic shape as well. So we've had many of these countries producing current account surpluses, but also we've had foreign exchange reserves moving up year after year. And so the strength of that has given them the confidence to defend their currencies when things have got bad. But also the reopening of economies in South Asia has been much quicker. So, for example, living in Singapore here, I can certainly say that we are finally pretty much back to normal. I mean, it was just in the last month or so that indoor masks were removed as well. And there's very little restriction here now in Singapore. I mean, in terms of traveling in and out is very easy. If I want to go to other South Asian countries, I mean, our analyst has been to Indonesia recently. It's not an issue. But going to North Asia is very, very difficult. I'm going to Hong Kong and China. Of course, we know how difficult that is. But even Korea and Taiwan, it's not that easy to go there. So those things have played a part. And actually there's low household debt in India and Philippines and Indonesia. And so the consumer has been in pretty good shape. The macro has been in good shape. And this faster recovery from COVID has been very important. The the kind of big negative at this point with North Asia is that even though headline CPI inflation is not kind of anywhere near developed markets, the slowdown in exports has been a great negative impact on North Asia. So the recent data, in fact, in the last few days, we've had export data from China, Taiwan, and then more recently also in Korea. It's been very negative. And if we see recessionary environment ensuing in Europe, US, which are two of its biggest trading partners, then that will have a negative impact. And so there are things to be wary of. The currency has been poor. There's still restrictions from COVID, and the export data is weak. So that explains the differential between North and South Asia recently.
Whilst the rest of the world seems to be dealing with either inflation or stagflation concerns, ASEAN countries seems to be relatively insulated from this. Why is that?
Yeah, well, actually, we've already seen a period, i.e., rising rates, stronger dollar, where you would have expected some kind of impact, but we haven't really seen that in ASEAN. The inflation numbers, I have to say, actually are moving up because in the ASEAN countries, for example, Philippines, Indonesia, India, sorry, India is not ASEAN, but if you talk about South Asia generally, the food and fuel, for example, are much bigger components of the CPI basket. So we are starting to see that moving up, though I think in India recently it seems to have leveled out. So maybe inflation won't get to the levels we've seen in the West, but I do think it will move up. But the growth has been there, and that's been the key, is that growth, for example, has been quite resilient. Vietnam, for example, is a great example in ASEAN, where growth has been very strong. But Singapore's ticking along very nicely. Retail sales have been very strong. The property market is strong. Asset quality is good here in Singapore. Unemployment is good. And you're seeing that across many of the ASEAN countries. So I think that even though inflation has come up, the concerns about growth are actually, much less severe than we had expected. So that's probably the reason why it's been a bit more insulated. And obviously the other factors we spoke about earlier as well.
We spoke about China a little bit, so I'd like to come back to that. To some, asset quality seems to be worsening, and now that's due to COVID-19 related lockdowns, the property slump that we've seen play out this year, and also some of the risks associated with small and micro loans. And then there's the general economic slowdown. So the question is, are investors underestimating some of the underlying risks in the Chinese economy at the moment?
Well, I would say that given everything that's happened in the Chinese market, I mean, namely this weakness we've seen for a couple of years now, I mean, investors seem to not be underestimating the risks because there's just so much has happened and the market's been so weak. So given how weak China has been, it looks as though everything is kind of out there now, and it's been a very rough ride. I mean, the negative sentiment amongst investors is at a level I haven't seen before. And the concerns are justified. It's been negative after negative, and many investors thrown the towel in terms of China. I mean, there was regulatory clampdowns, as the stress around properties you mentioned, rising household debt, weak earnings, and that was just in 2021. 2022 brought along a whole raft of new issues: the US ADR delisting efforts, the deteriorating US China relationship, especially with respect to Taiwan, and of course, this COVID zero policy. So that's new in 2022. So there's been no respite from that. You know, I would say one shouldn't be too negative about China because there are still some interesting areas where there are opportunities, and that's really where we've been looking. So that area is domestic consumption. Now, the trend that's been interesting is that despite all of this macro stress, um, the picture in terms of local brand share is very interesting. So if you look at data, for example, of what the local brand's market share is in, let's say, sportswear, it's about 40%, and that's been growing. In electric vehicles, it's about 75%. Bottled water is 85%. And there's some areas, for example, solar panels or high-speed rail, digital payments, where local brands have 100% market share. Now, we think that in many of those areas, local brands will continue to increase their market share. So we've been looking recently, for example, at a couple of names that have fallen 50%, and they're domestic companies that serve Chinese consumers. And they've just had a very rough ride because of everything that's happened. But the latest, for example, we own a sportswear brand. They recently reported about 20% growth. So, all is not lost in China. There are still some opportunities. Of course, there's a lot of concerns, and we are underweight in China. But that's not to say that China is uninvestable or there are not opportunities there. We have to be cautious, but there are opportunities, and generally, China is just really underrepresented in global indices. It has a very high share of foreign exchange reserves, money supply, GDP, of course, market capitalization. But the weight in indices is tiny. And we think that over time, the institutional ownership of Chinese equities will grow. It's taking a little bit of a backseat at this point, but the long-term trend is still there. And I think focusing on those domestic brands is a real opportunity at this point.
That's interesting. I mean, I guess one of the things that is playing out in the market at the moment is that most countries are tightening monetary policy. China has been loosening policy. Could this help spur growth in the country and potentially mitigate a hard landing?
Yeah, I mean that's a very fair point. There is, of course, potential for China to loosen. If you look at where even today, after the rate requirement cuts, it's still got a quite a high level relative to the rest of the world. And if you look at some of the restrictions in the property market, I mean they're quite onerous. I mean we see that in Singapore, for example, with the level of stamp duty in Singapore and Hong Kong. But there is, a lot of restrictions in terms of owning second, third properties in many places in China as well. So if the Chinese government wanted to loosen, they could do that. But what they have been doing, and we think this is the right path, is that they want to clamp down on what they believe to be speculation in some of these markets. They want to address the issue around debt. I mean, household debt to GDP has been rising year after year, and total debt to GDP is obviously at a very high number. That needs to be addressed, and they are doing that. Of course, that process is not going to be smooth, so that creates this kind of disruption and this move away from export-led growth, moving up the value chain. This talk about common prosperity, which is all about kind of more about redistribution of wealth, accepting that some of the structural growth and demographics and so on has come off. I mean, this is I think it's to be expected that there's going to be some kind of dislocation when this kind of change in the economy occurs. So we have to be obviously aware of that, and that's why the Chinese government is not loosening at the kind of pace that investors had expected, and that's been creating some disappointment. But we can't have it both ways. If you want Chinese to clamp down on debt and address some of this speculation and so on, and move towards higher value chain, moving away from export-led growth, then there has to be an adjustment period. And if you want them to just continually turn on the taps that every time there's some kind of pressure, then that actually adds to the long-term problem. So I think they are doing the right things, but it's been quite messy. And I think the way that, for example, the regulation was handled around many of these industries over the last year or so, that was not a very clean way of doing things. So I think that in a way, and the COVID zero policy, it's been self-inflicted. And so we have to see how that pans out. But as I mentioned, there are still some opportunities in the market that we are looking at.
So just before we finish, I would like to talk about dividends. We've seen Asian companies paying out higher than expected dividends over the last few years. Are these levels of dividends sustainable, and will they continue to grow in the future?
Yes, well, the evidence of recent years tells you that not only have dividends in Asia been very resilient, for example, 2020 was great evidence of that, a year of COVID, where other markets really suffered in terms of dividends. I mean, Asia didn't. It was quite a smooth kind of level of dividends throughout that period. And then we've seen growth post that period. The underlying trend in dividends in Asia is certainly positive, and it has been after the recovery from COVID. Though I have to say the performance amongst the various Asian markets was mixed, if you look at some of the recent data. But that does highlight the benefit of a region which encompasses markets with high sustainable yields, such as Australia and Singapore, and then markets where dividends are in a structural growth phase, such as China. And so that diversification is really a key benefit of looking for income in our region. It helps to smooth, to a degree, the overall picture for Asia, and it's likely to be an important factor when we look ahead to a slower period of growth, which we are facing now. So, whilst there are areas such as mining dividends in Australia, which look to have peaked, there's still underlying strength, for example, in Chinese dividends, in Taiwanese dividends. And so different markets are in different phases of maturity with respect to payout ratios. And that's been supporting this long-term growth in Asian dividends. So, that picture is very clear. We've seen good evidence of that. And that alongside the robust performance of the region during COVID continues to highlight this longer term attraction of income in our region. And we've been very positively surprised by dividends, the level of dividends coming from China, from Australian materials and energy, from Taiwan. It's been a good year for dividends in Asia. So we remain optimistic there, I have to say.
Great. Well, that's all we have time for today. Sat, thank you for joining us.
Pleasure. Thank you.
And thank you for listening. If you enjoyed this podcast, please subscribe, rate, review, and share this with anyone you think will also find this interesting. If you want to learn more about investment trusts, we have a wealth of information available on our website, which you can find in the show notes.
References made to individual securities do not constitute a recommendation to buy, sell, or hold any security, investment strategy, or market sector, and should not be assumed to be profitable. Janus Henderson Investors, its affiliated advisor, or its employees may have a position in the securities mentioned.
Important information. Not for onward distribution. Before investing in an investment trust referred to in this podcast, you should satisfy yourself as to its suitability and the risks involved.
you may wish to consult a financial advisor. This is a marketing communication. Please refer to the AIFMD disclosure document and the annual reports of the AIF before making any final investment decisions. Past performance does not predict future returns. The value of an investment and the income from it can fall as well as rise, and you may not get back the amount you originally invested. Tax assumptions and reliefs depend upon an investor's particular circumstances and may change if those circumstances or the law change. Nothing in this podcast is intended to or should be construed as advice. This podcast is not a recommendation to sell or purchase any investment. It does not form part of any contract for the sale or purchase of any investment. We may record telephone calls for our mutual protection, to improve customer service, and for the regulatory record-keeping purposes. Issued in the UK by Janus Henderson Investors. Janus Henderson Investors is the name under which investment products and services are provided by Janus Henderson Investors International Limited. Reg number 3594615. Janus Henderson Investors UK Limited. Reg number 906355. Janus Henderson Fund Management UK Limited. Reg number 2678531. Henderson Equity Partners Limited. Reg number 2606646. Each registered in England and Wales at 201 Bishopsgate, in London, EC2M 3AE, and regulated by the Financial Conduct Authority. And Henderson Management S.A. Reg number B22848 at 2 Route de Bitburg, L1273, Luxembourg, and regulated by the Commission de Surveillance du Secteur Financier. Janus Henderson. Knowledge shared and knowledge labs are trademarks of Janus Henderson Group plc or one of its subsidiaries. Copyright Janus Henderson Group plc. Henderson Far East Income Limited is a Jersey fund, registered at Liberté 1923 Lamont Street, St. Helier, Jersey, JE2 4SY, and is regulated by the Jersey Financial Services Commission.
Diversification, a way of spreading risk by mixing different types of assets/asset classes in a portfolio. Monetary stimulus refers to a central bank increasing the supply of money and lowering borrowing. Assets with low correlation should provide the most diversification. Consumer price inflation, CPI. The Consumer Price Index measures the overall change in consumer prices based on a representative basket of goods and services over time. Inflation, CPI, the rate at which the prices of goods and services are rising in an economy. The CPI and RPI are two common measures. The opposite of deflation. Monetary policy, the policies of a central bank, aimed at influencing the level of inflation and growth in an economy. It includes controlling interest rates and the supply of money. Monetary stimulus refers to a central bank increasing the supply of money and lowering borrowing costs. Monetary tightening refers to central bank activity aimed at curbing inflation and slowing down growth in the economy by raising interest rates and reducing the supply of money. Price to earnings, PE, ratio, a popular ratio used to value a company's shares, compared to other stocks, or a benchmark index. It is calculated by dividing the current share price by its earnings per share. Stagflation. Stagflation is an economic cycle characterized by slow growth and a high unemployment rate accompanied by inflation. Economic policymakers find this combination particularly difficult to handle, as attempting to correct one of the factors can exacerbate another. Yield, the level of income on a security, typically expressed as a percentage rate. For equities, a common measure is the dividend yield, which divides recent dividend payments for each share by the share price. For a bond, this is calculated as the coupon payment divided by the current bond price.